Welcome. My name is Opeyemi Onadiran, a real estate consultant and wealth advisor, and I welcome you to Epignosis Corner. This is a community where you will learn everything about real estate and finance. In finance, we're going to be focusing on managing your money and multiplying your money through investing. And on this note, we'll be starting to explain the term investing. We'll break investing down into different parts so that as an expert you understand more, and as a baby or someone who does not know anything about investing or have not started investing yet, you understand investing, because I will explain investing like a baby so you can understand, no jargon and all of that. So quickly, let's dive into it. I define investing as the act of committing money or other resources into assets such as a real estate, stock, bond, or businesses in order to generate income or make profits over time while accepting some level of risk. You invest your money into assets such as real estate, bond, stock, or businesses. Of course, these are not the whole investment vehicles, but will be, because of this video, we limit ourselves into this for to generate income or profit while accepting some level of risk. Now, the first part is act. Investing is an act. It is not intentional. It is intentional rather. You must be intentional about making investment. You must be intentional about your financial life. You must be intentional about your future. You must be intentional about your freedom, about your financial freedom, building wealth and building legacy for your children's children. The scripture says a good man keepeth inheritance for his children, not just his children, but his children's children. That is, a way at which the scripture define or describe a good man. Now, many people wish for wealth. Few actually take steps to create it. So you must go beyond wishing. You must be ready. You must take deliberate steps. If you want to start investing, investors learn to make money work for them. This is what is beautiful and what separates consumer from investor. Investor learn to make money work for them. The first step, or let me say the first stage of investing is to make money. You work for money. Now, the second step, which is greater than the first, is to make money work for you. When you invest, when you work to make money, either with physical energy or with mental work, when you make money, you don't spend all the money, you invest those money. You make those money work for you, so that while you don't work, while you sleep, your money keep working for you to produce more money. No investment portfolio is built by good intentions alone. You cannot just say you have good intentions. You want to invest and keep wishing. No investment portfolio is built with that. Investing is fundamentally a behavioral discipline before it becomes a financial strategy. Now, the second part is committing money or other resources. When it comes to investing, money is the simplest commitment to investing. There are other resources too that you can commit to investing. Most people think investing only requires money. It is not true. Money is a resource in investing. There are other resources that you can commit to investing. Money is one resource. Time is a resource. Knowledge is a resource. Relationships are resources. Skills are resources. So those are stuff that you can commit, to investing. When you have money, that gives you investment. Time is also a resource. What I'm doing now takes my time. And what, as you are watching me too, it's also time because you are learning and dishing out to value, you are taking in value. It is a form of investment because at the long run, we'll get to where all of these things, make money for us. Knowledge is also a resource. When you pick up a book, you buy and then you begin to absorb knowledge. It's also a resource because, of course, like we said, that investing is art. Then you put to use that knowledge that you acquire from that book or from skills and all of those. And relationships are also resources. The relationship you keep that gives you information, valuable information, the relationship that gives you access to great people, influential people, and all of those. They are also resources because I don't know, you commit those relationships to assets. You will get there very soon. Skills are also a resource because skills bring you money, you commit those money into asset. And now look at this. An entrepreneur invests capital. If an entrepreneur, you want to start business, of course you need capital. Now a student invests years of learning valuable skills. A business owner invests trust and network. When you build business, you have a product, of course. And when you deliver that which you promise to people, in your products, you build trust in the heart of people. People trust your business more, they trust your products more. Then you network with people in your industry, big men in your industry. When people see you with them, if okay, you are doing well to have met these people, to have seen with these people, to have done with these people, to have talked with these people, and all of those, then you begin to build trust and then network. Every what why returns demand and input. So there's no output without an input. And of course, your input is going to be useless without output. What resources do you have today that can put to productive use? That is the question you should ask yourself. What are those resources you have? Is it product? Is it knowledge? Is it skills? Is it money that you can put into productive use that can bring value to you at the long run? Now check this. Financial capital is only one form of capital. Human capital, social capital often generates the highest return. Now the third part in our definition is committing. We have talked about committing money and other resources. Now, where do we commit these resources? We commit them into assets. We commit it into assets. Now, notice from the definition, it is not liability, it is asset. An asset is something that puts value into your pocket or increase your net worth over time. Now, everything that brings money into your pocket is an asset, like the popular opinion by Robert Kiyosaki. But you see, because something take money out of your pocket does not mean it is a liability. And there are stuff that take money out of your pocket that saves you a lot of probably time, energy, and the likes like that. There are stuff that take money out of your pocket that brings you into class of people. That some class of people welcome you, and this class of people does not just welcome you. You gain information, you gain access, and at the long run bring money, greater, much more money into it. So asset does not necessarily mean liability, rather does not necessarily mean everything that takes money out of your pocket. An asset that can take money out of your pocket in a short while, but at the long run bring money into your pocket. Sometimes an asset only take money out of your pocket. It does not bring money to your pocket, but it adds value to stuff that bring money to your pocket. Let me give you an example. A private jet is a liability because, and at the same time, it's also an asset. It depends on how you use it. If you buy a private jet, you cannot use it in your home because of the expenses that comes with maintenance, keeping, anger and the likes like that. If you put it out for rent, it brings money to you. And of course, if you're a businessman, a big business owner, rather, that you have, conglomerates, you travel here and there across multiple continents, you may have to save time because you have a lot of places to visit within a short period of time, and you don't want all these sorts of delayed flights and the likes like that. That becomes an asset because it saves time, it saves energy for you, and that makes you makes best use of your time. And let me give you another example. An asset could be your phone. And you see, it depends on how you use your phone that makes it an asset or makes it a liability. Like what I'm doing right now, I'm using my phone to record this video. When you own a phone, you buy it, it takes money out of your pocket. You recharge it to make calls, to text message. You subscribe data on your SIM. It takes money out of your pocket. But you see that data subscription gives you access to internet. So it now depends on what you use that internet to do that makes the phone either an asset or a liability. In a short while, it takes money out of your pocket, but at the long run, it brings money into your pocket. Because I'm using my phone to record this video, I will edit and then post on the internet. You watch it because you have data on your phone. You acquire knowledge, and if you make use of this knowledge that you acquire from this video, at the long run, it brings money into your pocket. While phone takes money out of my pocket in a short while, at the end of the day, it brings money to me more than it took out of my pocket. So an asset can be like that. This, wireless microphone could be an asset to me because it takes money out of my pocket when I bought it, but it adds value to me because it helps me record this video so that you can hear me clearly. So it's an asset because it adds value to me. It adds value to other stuff that I'm doing, so money can come at the long run. This system is an asset to me because of what I use it to do. It adds value to me. I store stuff on it. I use it to, design, to type and do a lot of stuff like that. It's an asset. Although it takes money out of my pocket, I, subscribe to it according to my Wi-Fi and the likes like that. But at the long run, it adds value to me, and that value helps me make more money. So it depends on what you acquire and what you use them to do that makes it either a liability or an asset. Many people spend money. Investors acquire assets. While many people spend money, they spend every damn money that comes into their pocket, but investors actually acquire assets. Now, this is how you know if you're a consumer or you are an investor. Consumer asks, can I afford it? And investors ask, will this produce value? If you ask yourself this honest question, everything you ever have today, are they asset or liability? If you want to buy stuffs, again, you want to buy new items, new stuffs, you ask yourself, if the only question you ask yourself is, can I afford it? Without asking yourself, what value will this bring to me? What value will this add to me? What value will I use this thing to produce? Then you are a consumer. But if you ask, what value will this bring to me? What value will I use this to produce? Then you are thinking like an investor. And that is how to manage your money the right way. Wealth is often the result of owning more assets than liability. Wealth is often the result of owning more assets than liability. Investment success depends heavily on asset allocation rather than simply any high income. So because you earn high income, if you cannot channel those income rightly, you will not build wealth. You will not be financially free. You are not in fact, you are not investing. But if you acquire more assets than liability, of course, then you are building wealth. And the truth is, there's nobody in this world that does not have liability. You have items, you acquire stuff that add no value to you. In fact, there are stuff that we have that in a short while they take money, in long run they take money, and they produce us no money. There's no, even me as I'm talking to you, I have such items. So everybody on this earth have liabilities in our possession. But what makes us an investor is that we acquire more assets than the liabilities. Our asset outruns our liability. And that is what I advise you to do. Now, the fourth part is such as, those assets. We are listing those assets. Now, like I said earlier, that we will be limiting those assets to 4 classes, 4 drivers, such as stocks, bond, real estate, or businesses. Now, investing wears different clothes. Like Yoruba adage that says, "Onakan waja," which means there are many routes to market. So if we are all going to the marketplace, but we can, follow many routes to the market. So it does not mean you must stick to one. In fact, there are other vehicles to investment which is not listed here, which is beyond stock, bond, real estate, and businesses. But we are sticking to these 4. Stock make you part owner of a company. When you commit your money into stocks, that means you are buying a part of a company. What you are saying is that I want to become a part owner of this company, and you are declaring that you want to make money with them and make losses with them. That is what you are doing with stock. Bond allow you to lend money in exchange for profits. When you invest your money in government bond, corporate bond, you are saying that I have money, I want to lend you, and I'll take my capital back with interest. That's what you are not buying a part of the company. Of course, when you invest in government bond, you are not buying a part of, the government rather. You are only lending the government money, and then you are taking your money back with interest. And the same thing with corporate bond. You lend your money, when you're investing in money, that means you are lending the corporate your money, and then you're taking back your money with interest. Now, real estate gives you ownership of property that can appreciate or generate income. When you invest in real estate, of course, there are several ways to invest in real estate without buying property. We are not going to do that in this video, but let's say you are buying a property. So you either make money through capital appreciation or rental income. But what you are saying is that you are buying this property, you are holding this property, you are becoming the owner of this property. Now, business allow you to build systems that earn beyond your personal labor. See, in investing, business is always underestimated when it comes to investing. People talk about commercial paper, short-term loans, stocks, bond, treasury bill, and the likes like that. But there are 2 vehicles to investment that gives the highest return, which is business and real estate. When you start a business, you are also investing. You are an investor. What if it's a startup and if you have no partner? What that really means is that you are the whole owner of your company. You are the only investor, and you 100% own your company. That is it. Then when people begin to come in, that people invest with you, they give you their money, then people are now investing in your business. You see, why stock, bond, commercial paper, all those ones like that, that people, emphasize and give you 15%, 10%, 25%, and sometimes 30% per annum. Business and real estate can give you much more. When you build business with favorable market, you can get 200%, 100% in a year. And even though it may not be considered that every year you begin to, make 200% return, but at the long run, you make much more, return than investing. That is the power of business. And the power of real estate is this, that real estate can give you 200% in a year. And real estate can consistently give you 100% or 50% for the next 20 years. Yes, for the next 20 years. Because if the beauty of real estate is that time and development multiplies your return. The more you wait and the more development that comes to the area where your property is situated, the more your return. Now, no single asset is perfect. It has strengths, it has weaknesses. There is no simple asset out there that is perfect. Best investors understand where each fits and diversify wisely. Now, the objective of investing in various assets of investment is not to copy someone else's portfolio. It is to build one. Like when you want to invest, you build your portfolio that aligns with your knowledge, that aligns with your objective, that aligns with your risk tolerance. Because I invest in crypto does not mean you should invest in crypto. Crypto is high risk investment. Now, the fifth part is to generate income or profits. The goal of every investing is to generate income or make profits. There is no investor out there. There's no business owner out there. There's no business builder out there that their goal is not to make profits or generate income, except you are into charity, and charity is charity. Every true investment seeks return. That return may come in two forms. First, income. Now, income is cash flow. When you invest in rental property, you make money either by long-term lease or short let. That is income. Dividend. When your stock company pay dividends, you make money. That is cash flow. Interest from bond, you make money. That's cash flow. Commercial paper, you make money. That's the cash flow. And the rest like that. Now, profit is growth. To make profit, there must be growth. When you build business and then you grow, you make profit. When you buy a product at a lesser price and sell at a higher price, you make profits. When your property, let's say you invest in land, when land increase in value over time and because of development, you make profit. Now, when you buy gold at cheaper rate and sell at higher rate, you make profit. Now, cash flow feeds today's need. Capital appreciation build tomorrow's worth. You need cash flow, you need building of worth. And what I always tell people is that if you are still struggling financially, if you don't know what to eat tomorrow, in fact, if you don't know what to eat at night today, investing is not calling you. In fact, investing is not calling you. Investing is only flashing you, and you should not call back. Your first assignment as an individual, family, or corporate is stability, to be stable financially, and then you can begin to think about investing. And if you want to invest as a stable person financially, you can think of cash flow, yes, as your first choice. Or if you can wait for a long time for massive return, you can think of capital appreciation. So you think of cash flow or capital appreciation when you are stable financially. So balancing cash generating assets with growth assets creates financial resilience. So while you invest in income producing assets for cash flow, you also invest in assets that generate value over time, capital appreciation. So you don't keep one for other, because both generate value and both give you financial resilience. They give you stability. They give you what is truly called financial freedom, wealth, and of course wealth building, so that you can keep inheritance for your children's children. The sixth part is overtime. You see, this overtime is underrated in investing. Let me tell you this. The scripture says, cast your bread upon many waters, and after many days you will find it. That many days cannot be quantified, because that many days can be 2 years, can be 6 months, can be 1 year, can be 10 years, can be 20 years. It is over time. The scripture call it many days. So it cannot be quantified. It depends on several factors that will bring return or bring massive return at the long run. People overestimate what can happen in 1 year. They underestimate what can happen in 10 years. You see, ah, especially in real estate, people can promise you heaven and earth within 6 months. And of course, you see that property that they are promising you 1 year, 1 year and a half, 6 months, they are still selling that property. Not talk of return. They, people can overestimate what can happen in 1 year. Of course, can stuff happen in 1 year? Yes, stuff can happen in 1 year, but they overemphasize on 1 year. Then they underestimate what can happen in 10 years, what can happen in 20 years, what can happen in 30 years. There's a particular man who came around during one of our locations at Ibadan last year. He invests also, he's also getting allocated that day. He now said he has been an investor, especially he loves investing in land over 25 years. Now he said he came back from where he came from to Ibadan, you know, 20 years ago. Now over 20 years ago, he said he bought an acre in a particular place in Ibadan at 18,000 naira per acre, and he bought 50 acres. Now in that axis, they are selling 1 acre at 80 million last year. Just do the math yourself. It is running into million, if not billion, and he's still buying land up to today. So those are, the power of long term. So as an investor, you don't just think short term. If you are doing business, you can be thinking about short term. If you are an investor, you can be thinking about long term, because long term actually compound and it gives you the highest, return. Then with Elon Musk recently become a trillionaire in dollar. That's massive, a lot of money, and as of yesterday, it was $1.3 trillion. Massive one. In 2006, Fonda Fund invested $600 million in SpaceX when SpaceX was struggling financially and about to, go bankrupt. And now in 2026, their money, 600 million, is now worth over $50 billion in SpaceX. Think about it. 2006, 2026, that's 20 years. So don't underestimate what can happen in 10 years, because the longer you wait, especially in real estate, the longer you wait, the more your return. Now, the last one, which is while accepting some level of risk, investing is not without risk. Investing is not without risk. You must have risk tolerance before you can invest. Risk is not the enemy of investing. It is its admission fee. When you get admitted into tertiary institution, you pay admission fee, of course. So in fact, let me call it is the acceptance fee, that you accept to take risk, then you are investing. Now, every investment carries uncertainty. There is no investment out there that has certainty. There is uncertainty in every investment. Check this. Stock fluctuates. Business can fail. Property can lose value. It goes up today, comes down tomorrow. It jumps at a particular level like that. When you watch the chart, just see green candles, green candles, the likes like that. Business can fail. Check this billionaire $10 when he had issue with Fort Oil. He bought, oil at $500 million. Why the oil is on the sea, not even getting to Nigeria yet, market fell, and he lost a lot of money due to that. Of course, it bounced back because he knows what he's doing, and he's a good investor, just like Warren Buffett in the United States. So business can fail, and then property can lose value. Just let me ask you this: how many people want to go to Iran to buy property? How many people even want to go to Borno State or Plateau State in Nigeria to buy property because of the unrest, the war, the insecurity that is facing them in those areas, and areas that are prone to earthquake often lose value because nobody wants to go there to build. So anything can happen to investing. Investing is not without risk. In fact, even if you invest in low risk investments such as treasury bill, bond, or money market fund, mutual fund, and likes like that, they still come with some level of risk, because let's say you invest in government bond and then there is unrest in your country or in that particular country. There's insecurity, or that country is fighting against another country, or another country is fighting against them, or there is civil war in that country or your country, of that particular government bond that you invested in. Who is going to pay your return? Where will you get your capital? That's it. So there is no investment out there that is not without a risk. Risk is the acceptance fee of every investment. Now, Holding cash carries the risk of inflation. Even if you say you don't want to invest because of the risk that is involved, holding cash in your account in your house also carries because inflation eats it up, especially in Africa. You don't do that. Now, this is the concluding part. Investing is not gambling. Investing is not luck. Investing is not getting rich overnight. It's not get rich quick scheme. There are a lot of Ponzi schemes out there parading themselves as investing. Because how will you explain it to me that there's a platform online or offline telling you that they will give you 30% return on your investment every month? It is simply gambling. It is collecting from poor and giving to Peter. But if you have risk tolerance and you can, you know, go away with that money, of course, you can invest, but it's not a good way. It is Ponzi. It is gambling. And it's not good because it is even addictive. It is much more addictive to proper investing. Let me tell you this. I have a friend, a few years ago. Then I'm not even in finance. I've not even gotten into real estate, not stock or finance. She saved up 500,000 naira and asked me what she can use that money to do. And I said, okay, you can buy land because while growing up, we know all these things that people used to say that land does not depreciate, it appreciates in value, and which is true. You can buy land and even mention a particular community. Then they were selling a plot in that community at 200,000 and even very close to the major road. And of course, she told me about a particular person who promised to be giving a 12% on 12% return every month on that 500,000 naira. I was like, oh no, I don't think this can be possible because the only thing I know then about investing is fixed deposit. So I know, and fixed deposit does not even give you 10% as of that time per annum, not talk of 12% every month. So of course, she didn't, subscribe to my advice. She went on to give that person the money, and up to today, no cash, no return, no capital. Like there's no return on investment and there's not even capital. So there are a lot of gambling schemes out there that parades themselves as investing, but you must be wise and of course to discern which one is investment and which one is not investment. There are people who partner with businesses. There are people who do joint ventures aside all this stock, commercial paper, real estate, and the likes. They do stuff together and then they make money. Just be careful of the one that you invest your money in. The thing is, investing is not gambling, it's not luck, it's not getting rich quick overnight. Investing is sacrificing some comfort today to create greater opportunities tomorrow. Now, this is what I have for you today in this first video of Hypnosis Corner. And the next video, we'll be talking about understanding real estate. I will explain real estate with simplicity, even much more than what you get here. Do well to subscribe to this channel, follow, this community. You can save this video, you can comment your opinion below this video, and of course you can share our video to people who may need to watch this and of course listen to this and take it. But you see, understanding something, acquiring knowledge is not important as taking necessary steps. My name is Opeyemi Onadiran, a real estate consultant and wealth advisor. See you on the next video. Thank you.